Welcome back to Investing with Confidence. I am your host, Joshua David, having a good time talking about the financial markets and those erroneous beliefs that most people have in their trading and investment strategies, hopefully helping them with some proper beliefs to make better investing decisions. Don't forget to subscribe to the podcast wherever you listen to podcasts and check it out on YouTube. So, Al, as we get into this next topic and segment, we got into how the public is doing certain things and, quite frankly, conditioned to do them, right? We talk a lot about the smart money, which we're referring to the banks, the institutions, Wall Street, the people and the companies that are moving these markets, the big money.
Right.
Now, it doesn't matter which way the market goes for them because they are buying long, and they are also selling short.
Right.
So they are always creating income in the markets. And you referenced to in the first segment about the public is conditioned to buy low, sell high, or buy and hold, right?
Right.
Which is one directional trading. Now, let's talk about that because the institutions are always creating income. The public typically isn't, mainly because they're uneducated, but they're also doing a one-dimensional strategy. Think about it as an athlete. If you're a one-dimensional athlete, are you going to be in pro sports very long? Probably not.
Yeah.
Well, investing, you need to be multi-directional in up, down, and sideways with those strategies. Let's talk about that, some of that stuff.
Yeah. The real problem is that people are not educated. They're not counseled on how to take advantage of two of the three different market directions. One is down and one is sideways. So it really is conditioned to do that buy with a one-way direction kind of investment. And that, think about it. If you buy a stock or you buy a mutual fund, what direction does the price have to go for you to have the potential to make money?
That has to go up.
It has to go up. Well, what happens if it goes down? Are you okay with losing money? What happens if it's sideways and you're not participating in a beneficial way? Well, you don't have to do that. You can participate in 3 out of 3 directions. But in that first segment we were talking about buy low buy low and sell high. And a lot of people might be thinking, well, if I'm looking at a stock like Apple, that means I would have had to buy it at a couple dollars a share. It's way, way above that now. So let's look at it a little different. Let's look at it as buy right and sell right. And to buy right, it means identifying on a price chart a price where the odds are in your favor that the price is going to increase in value. To sell right, that means the odds are in your favor that the price is going to reverse and go down. But in both cases, it should be a price where you have the potential for large gains. That high reward part, that comes with getting in at the start of a movement, and the low risk entry, that's at the turning point in prices. So the important thing is to identify the proper price because that's paramount to the potential for success. And that's where high volume buy orders or high volume sell orders are kind of waiting to come in the market. So it gives you an opportunity with the right strategy that can identify the activity by those big institutions to identify actually beforehand where their trades are going to take place. Would that give you an opportunity to participate? If you could actually be positioned to take advantage of their movement. And we want to take advantage of their movements because they do it in such high volumes. I mean, they may be putting millions of shares together in an order to either enter or exit. That's what you want to follow. And the great thing for us is that they do all the hard work. You mentioned before what people are conditioned to do is look at fundamentals, look at a balance sheet,
analyze things.
Well, the institutions already have that knowledge. Sometimes they have knowledge you never get. So by the time you finish analyzing something, a good part of the movement of that price has already taken place. So you're not participating in the full trend.
That's a great point there. Think about this. Now, the retail investors, the public is trained to analyze things, right?
Sure.
Do they even know what they're analyzing? I mean, think of it this way. Is a doctor going to go analyze something for a engineer? Probably not.
Yeah.
But that's what the public is doing. They're trying to analyze something they don't understand. That's why you got to let the institutions do that work.
Sure.
And then learn the skills and techniques to trade like them.
Yeah, well, even if you analyze something and even if you have the ability to identify what are great fundamentals for a company, the price of that particular asset isn't going to move unless there are buyers out there. You could have the best company in the world with the greatest product ever conceived, ever produced, but if no one buys the stock, the value will not go up. So it really is not just the fundamentals. That's something to consider for long-term investments. But for short-term, and think about the way this market has been moving. We see the sometimes several 100-point movements several times during a day. That
Yeah.
doesn't mean that the fundamentals changed every time it
It
happens.
happened on the 23rd of
It
February.
happened on the 23rd. I mean, the NASDAQ at one point was down over 500 points. It came back several hundred points. So the fundamentals didn't change every time the price changed. It's just buyers came in and drove it up. Sellers came in and drove it down.
But the key was right there is there were still opportunities though.
Oh, absolutely.
You have
Sure,
these
sure.
big swings in these markets up and down. When you understand the proper strategies and techniques for every market condition, heck, let it go up 200 points,
Sure.
let it go down 200 points, but be in the proper strategy to capitalize on both those.
Yeah.
You have to learn a strategy that's designed to do that. And you teach a lot of investing classes and talk about different strategies and techniques that are designed to make better investing decisions in all market conditions. And you got to have that core strategy. You brought up a great point earlier. You said you got to look at things differently. You said buy right and sell right.
Right, correct.
Now, people just they do that buy and hold strategy, but with that Apple example you gave, you buy an Apple at a couple bucks, yeah, that would have been very nice for a lot of people. But the fact of the matter is you can't do that anymore.
Correct.
But the proper thing you can do with different asset classes is utilize leverage and proper time frames within your investing and trading strategy. So talk about some of different techniques to use leverage on a smaller scale, not day trading, just on a smaller scale to make those decisions off of a price chart.
Well, let's say that you and your spouse are out looking at houses, and you drive by a house that you fall in love with, and the price of that house that's on the market is $400,000. You do not have to go in with $400,000 in cash, plot it down on the table, and you own that house for $400,000. More than likely, some people can do that, but more than likely, you're going to take out a mortgage where maybe you put $40,000 into that particular home. Now you own a $400,000 asset for $40,000. That's leverage.
Okay.
So that's fantastic. Well, what if you could do that in the market? So instead of putting a position together in Apple that might cost you $13,000 for 100 shares, what if you could do that for just a fraction of that, maybe $500 or $600 or $700, depending on the asset or the option that you're using. You can do it with options where you have the opportunity to have a small amount actually controlling a larger overall investment. That's leverage. That's really maximizing the value of your investment dollars. Why do the institutions use that? Why do they do that? And really, why do they do it and not tell you about it? You, as their clients, are put into that buy and hold strategy. Well, they're using it. The big money, the smart money is using it because they understand the benefits there. Those assets, like options, like the futures market, the foreign exchange market, two of those three trade 24 hours a day, futures and Forex, futures 23 hours and 45 minutes. They all have leverage. There's all of them have good liquidity, which means you shouldn't have a problem finding somebody to take the opposite side of a trade for you. But the leverage part of it is huge. It allows people with smaller accounts to still participate in those assets that have a higher value. The futures market, for example, that is comprised of a number of different things that give you the opportunity to be truly diversified. The futures market will let you trade the major stock markets. It will let you trade commodities, one of which is Josh's favorite, which would be
lean hogs.
Lean hogs. You can trade precious metals, gold, silver,
oil. You can do oil, natural gas,
interest rates.
Think about natural gas right now with what had happened in February in the South.
Sure, in Texas, absolutely. And there are different sectors there that some of which are correlated to each other. Some have no correlation, no association. Some are inversely correlated. So you can have a truly diversified portfolio just within the futures market. Trades 23 hours, 45 minutes a day. Leverage can be anywhere from, say, around 20 to 1 to over 100 to 1. The Forex market, the foreign exchange market, where you're looking at different exchange rates, the difference in exchange rates between two different currencies, that has a 50 to 1 leverage. Trades 24 hours a day. A great asset for trading both shorter term and long term. A lot of people are now using the Forex market in their retirement accounts.
And just to give example on what that 50 to 1 really means. So basically, for every dollar that you have the potential to control up to $50 of that.
Hmm.
Now, that's leverage, being able to maximize your capital. So think about this. If you buy a stock, as I was talking about earlier, you need to put up or pony up, is what they
Right.
call it, and
Hmm.
the kids call it. They have to pony up all that capital to purchase that stock.
Right.
And then if that stock goes up $1, you make $1 on that stock. When you have leverage, especially in options, you can purchase it potentially at a lower cost rate.
Correct.
But with the futures and forex market, utilize that leverage in smaller time frames, and that's why the institutions are using that to create income. They have the opportunity with smaller amounts of capital because they're maximizing that efficiency.
Yeah, when you think about you mentioned the word income. When you're thinking about income, that typically is something that you need on a shorter term basis. It's
That's
not
basically the definition of it.
That's the definition of it. It's not something that you can wait 10, 20, 30, 40 years for to utilize. It's something that typically you need to use now. Maybe it's for emergencies, maybe it's for, putting the kids through college or just paying bills. But the institutions use that because they understand to kind of boost their bottom line, they can have that extra cash coming in on a regular basis. They're trading these things daily. They have traders that are out there not putting mutual fund portfolios together, but they are
They're selling them.
they're selling. I'm sure they have the financial advisors that are selling them, but also from a business standpoint, one of the reasons that they are not really pushing those assets with their clients is because of the amount of work involved. If you've got several hundred clients that you're dealing with and you're looking at a short-term trading vehicle like futures, futures is a great short-term vehicle for people that need short-term income. But if you have three or 400 clients, how can you possibly really manage a portfolio with something that may be trading on a every day or every other day?
You can't.
You just can't
And
do
that's
it.
why they put them in the buy and hope strategy.
Sure, buy and hope. I take that even a step further and call it buy and pray. But the leverage assets are great assets that are available to all of us. They can be used in up markets. They can be used in down markets. They can be used in sideways markets. But the key to make sure that you can participate properly is to also understand you have to be protected. And that's one of the things that I think where people fall short. They don't understand how to protect their assets, how to protect their portfolios. That's really the number one thing that we teach every person that comes through the Online Trading Academy.
Yeah, that's the capital management, how to protect what you have. Because if you can't protect it, you can't grow it. And that's the key thing that our sponsor, as Al's talking about, Online Trading Academy, teaches is how to protect what you have and then techniques and strategies to participate with all market conditions
Right.
in all assets, stock, options, futures, and forex. I mean, the futures and the forex market, I believe those are the two of the best markets for people. And that's the reason why the smart money uses them for
Sure.
income. That's why they
Absolutely.
do that. There's perks there. 24-hour markets, so you can participate in the evenings. But the key one I think people just don't understand, and that's why you're teaching these investing classes to talk more about, is that leverage. Al, what if I were to say, I'm going to go to the water fountain. I'm really thirsty. And in between that time from now till I get back, I'm going to pay you to wait.
Okay, let's do it.
Let's do it. Well, there's techniques and strategies that investors can potentially do that to get paid to wait.
There are.
We'll be right back.